In this video, I'm going to be going over the 3 main entry models you should know if you want to start learning ICT. I only use one of these, but I also use the other 2 as confluences in a lot of my trades. So personally, I think it's worth learning all 3. In order, we have a fair value gap, a inversion fair value gap. So the I stands for inversion, and then we have a just fair value gap, and then we have a order block. Okay, so these are the 3 main ones. I'm going to show you examples of all 3, one example each, and explain why they are what they are, and show you how you can enter, put a stop loss, and where to target. Here is an example of a fair value gap. So what a fair value gap is a candle formation where we get 1, 2, 3 candles, and it could be 4, it could be 5, but there's always going to be a candle that the first candle's high, so right here, does not overlap the third candle's low. So see how the low of this third candle and this high of this first candle do not overlap, and it creates this gap. So to draw this gap, you draw it from this candle's low right to this candle's high. Okay, and this is the first type of entry you can use. Now there's more to drawing a fair value gap, right? The reason why this is a good entry in this scenario is because we've actually taken out all these lows. So all the retail traders who think this is supposed to be support, they're trying to buy they're trying to short the breakout here, but then when we reverse, get sort of kind of a shift over the last lower high and then come back down to the fair value gap, that can often be a good entry. So the entry in this example would be you'd enter it when we tap into the fair value gap, which would be here. Stop loss would go beneath the low, and then the target would be the next major high, which in my opinion, I would probably say this is the next major high. So you do your take profit there. So that's how to use a fair value gap entry. The second entry is using a order block. Okay, so an order block is basically a candle formation where it's kind of a green or red candle. Okay, I'll explain the difference in a minute. Sandwich between another green or red candle. So let's say these 2 candles are green. Okay, so we had a green candle here, green candle here, and this candle's red. Okay, this red candle will be your order block because it's kind of sandwiched between, but that doesn't mean every time you see this formation it's going to be an order block. Okay, that's just playing a pattern. You want to make sure that we sweep a low or sweep a high, or we're delivering off of somewhere like another fair value gap to make this a high probability order block, because not every red candle sandwiched between 2 green candles is going to be an order block. Now, it's actually not an order block if the next green candle looks like this. The next green candle's body physically has to close above it, okay, to make it an order block. So you can see in this example, we're delivering off of another fair value gap from the lows, okay, and kind of get a nice run up. And then you can see we kind of have our red candle, and there's actually 2 of them here, but I'd say this is the most high probability one. It's kind of sandwiched between this green move up and this green candle here. So I draw a line at the open of that candle right here. Okay, now theoretically it is the whole candle. Okay, so what your entry would be for this order block entry would be you retrace back to the open. The stop loss would go beneath the low of the order block, which is right here. And then the take profit would go to the next major high, which I would consider probably right here. And you can actually see these are equal highs, also known as a double top, which retail traders are going to see as resistance. So this would be a order block entry. Now, you don't have to enter at the open every time. You could enter it at midway through the order block, but it's not always going to get hit. So your best chance of getting in is getting in at the open, because sometimes we'll wick and hit this open, and then price will just launch right off of it. So that's an example of an order block entry. And the reason why this is a good order block is because we've already kind of swept sell side liquidity here. We've made a nice move up here. We kind of got a little mini market structure shift in the lower time frame, and it's combined with delivering off a fair value gap, which makes this order block a better position to enter. And this would be a bullish order block. It's the same thing on the opposite side. If there's 2 red candles and a green candle, that would be a bearish order block, but I'm not going to go over an example for that right now. I just want to keep it simple and show you this is just an example of what an order block entry would be like. Okay, the third example would be an inverse fair value gap. So notice how we're bouncing off of this, okay? And notice how we put in a bearish fair value gap here. Well, in this situation, because we're very low in the range and because we've already swept sell side here, this or sell stops here, does it make sense to reject a bearish fair value gap after we've already taken out all these retail trader stop losses? No, it does not, right? Because if we've already taken out all the lows, we need to go back up and take out the highs before we want to go lower. As you all know, I only use inverse fair value gaps. And recently, I made a full free PDF of inverse fair value gap rating setups that I use to rate my own setups A through C. So if you want to check that out, just click the first link in the description. It's completely free and hopefully should help you. So in this situation, I look for this to be turned into a inversion fair value gap. So what I'd wait is I'd wait for a body close above. And you can see we don't close above here. So right here is where we close above. Then I'd buy, and my stop loss would be either one, you could do it to low, or two, you could do it a close below. So if he closes below, you could do that. Again, if you want to learn more about inverse fair value gaps, go to my playlist and go to my strategy playlist. And then the take profit would be the next high. Right there. So you can see we bounce from a fair value gap, get an inversion fair value gap, and then also form this order block if you missed all these entries. So you can kind of see there's 3 entries that I'm talking about in this video just in this leg. And theoretically, you could have entered all 3 of them. So if you missed this one, you could have taken the inverse. And if you missed the inverse, you could have taken the order block. Now, it's definitely going to be lower probability the higher up we are, but you can still see this order block was respected pretty well. So that's going to be it for this video. Don't forget to use code DODGY, 80% off sale for Apex right now. Buy a few prop firm accounts. They're gold. Trust me. We'll get you lots of practice. And that is it for now. I will see you guys in the next one. Peace.